Hello everyone, welcome back. So in this video, let us discuss about the butterfly spread strategy. It is an option strategy that combines two other strategies, the bull spread and the bear spread. These are what we call neutral strategies because they work best when the price of the stock doesn't move much. The best thing about butterfly spreads is that they come with a fixed risk, which means you know exactly how much you can lose. And the profit is also capped, meaning there is a limit to how much you can earn. So it is a strategy that uses four options and three different strike prices. So the first two strike prices, which are the upper and lower ones, are equal distance away from the middle one, which is the at the money strike. So to put it simply, the butterfly spread is great when you expect the stock to stay in a specific range and not move too much. So there are four types of butterfly spread. The first is a long call butterfly spread, which involves buying one ITM and OTM call option and selling two ATM call options. The second is a short call butterfly spread that involves selling one ITM and one OTM call option and buying two ATM call options. The third is a long put butterfly spread. This involves buying one ITM and one OTM put option and selling two ATM put options. The fourth is a short put butterfly spread, which involves selling one ITM and one OTM put option and buying two ATM put options. Let me explain the long call butterfly spread. Let's say the stock price of Adani Ports is trading currently at rupees 1232. An option trader believes that it will not move significantly over the next month. So he chooses to implement a long call butterfly spread to potentially profit if the price stays where it is. Let's check the option chain for more details. So when we set up a butterfly spread, we are using four options with three strike prices. A lower one, a middle one and the higher one. Now in this example, the lowest strike price is 1220, the middle is 1240 and the higher is 1260. So let's buy one ITM call option with 1220 strike price at rupees 50.65 premium. Buy another OTM call option at 1260 strike price at rupees 30.15 premium. And then sell two ATM call options with a strike price of 1240 at 39.5 rupees as premium. Let us use MS Excel to compute the total profit or loss for this strategy on the expiry date with varying market situations. First, let us compute the profit or loss for long ITM call option. So here we use a formula maximum of spot price minus strike price is 0 minus the premium per share. Here we get a loss of rupees 50.65. Next, let us compute the profit or loss for selling two ATM call options. So here we use a formula premium per share minus maximum of 0 or spot price minus strike price into 2. So here we make a profit of rupees 79. Next, let us compute the profit or loss for long OTM call option. Here we use a formula maximum of spot price minus strike price is 0 minus the premium per share. So here we make a loss of 30.15. Let us now combine all the legs to find the net profit or loss. So we get a net loss of rupees 1.8. Now drag the formula to the rest of the cells. Before that, don't forget to log the cells containing premium and the strike price. Let us also draw the payoff graph by selecting the spot price on expiry and the total profit or loss and choose a scatter plot. Alright, let's take a closer look at how we calculate the maximum profit in a butterfly spread. So the maximum profit happens when the stock price at expiry is exactly equal to the middle strike price. So in our example, that's 1240. Why? Because at this point, the options you sold at the middle strike price expires worthless. So this allows you to keep the full premium from selling those options. Meanwhile, the other options you bought, that is at the lower and the higher strike prices, ensure that your overall position is profitable. Now, how do we calculate this maximum profit? We start by looking at the difference between the lowest strike price and the middle strike price. In our case, the lowest strike price is 1220 and the middle strike price is 1240. So the difference is 1240 minus 1220 gives us 20 rupees. This represents a maximum possible gain from the strategy. But remember, when setting up the butterfly spread, you had to pay a net debit upfront. In our example, the net debit was 1.8. So to find the actual maximum profit, we subtract this net debit from the difference between the strike prices. So the calculation becomes 20 minus 1.8 gives us 18.2. So this 18.2 is the most you can earn from the butterfly spread if the stock price closes exactly at the middle strike price of 1240. Now what about the maximum loss? So this is easier to understand because it is simply the net debit we paid when we entered the trade. So no matter what happens, the most you can lose is 1.8. So that's why the butterfly spread is such a safe strategy. Your risk is limited. Finally, let's talk about the break-even points. So these are the points where you neither make money nor lose money. There are two break-even points for a butterfly spread. The first one is a low break-even point. So we calculated it by adding the net debit to the lower strike price. So 1220 plus 1.8 is 1221.8. The second one is the upper break-even point. For this, we subtract the net debit from the higher strike price. So 1260 minus 1.8 gives us 1258.2. So in short, your profit zone is between 1221.8 and 1258.2. And the maximum profit of 18.2 happens right in the middle at 1240. So this strategy works best when you expect the stock price to stay close to the middle strike price. So it is all about limited risk and controlled rewards, making it a great choice for a less volatile market. So that's all for this video. I hope this explanation makes a butterfly spread clearer for you. See you in the next one. Thank you.